When the VIX curve flips upside down, most traders see one word, crash, and they either freeze or they buy the fear at exactly the wrong moment. But the VIX term structure is not a panic button. It's a map of what the options market expects volatility to do over time, and reading it properly is one of the cleanest edges a retail trader can build. Before we go further, one thing, this is educational commentary, not personalized financial advice. Nothing here is a signal to buy or sell anything. Let's start with what the VIX actually is, because most people get this wrong. The VIX is not a prediction of direction. It's the 30-day expected volatility of the S&P 500 pulled out of the prices of SPX options. When option prices get expensive, the VIX rises. When they get cheap, it falls. So the VIX is really a thermometer for how much protection people are willing to pay for right now. But the spot VIX is just one number. The interesting part is the term structure. VIX futures that expire in 1 month, 2 months, 3 months, all the way out. Plot those expirations on a chart and you get a curve. In calm markets, that curve slopes upward. Near-term volatility is low, and each further out month is priced a little higher. That upward slope is called Contango, and it's the market's default state roughly 80% of the time. Why does Contango dominate? Because uncertainty grows with time. You have a decent idea of what tomorrow looks like. You have almost no idea what happens in 3 months, so distant volatility carries a risk premium. That premium is exactly what volatility sellers harvest, and it's why products that short volatility tend to grind higher for years, then blow up in a single week. Contango is the calm that pays you until it doesn't. Now the flip, backwardation, is when the curve inverts. The front month spikes above the later months. Near-term expected volatility is suddenly higher than volatility 3 months out. In plain English, the market is saying, something is wrong right now, but we expect it to calm down eventually. Fear is concentrated in the present tense. Here's the mechanism that matters. Backwardation almost never happens in a slow drift lower. It shows up in sharp, fast sell-offs. Think of the COVID crash in March 2020 when the VIX hit the low 80s. Think of the August 2024 yen carry unwind when the VIX briefly spiked toward the mid-60s intraday before collapsing within days. In both cases, the front of the curve exploded while the back stayed relatively anchored. The curve was screaming acute stress, not a permanent regime change. So what is backwardation really telling you? 3 things. First, positioning is stretched. Someone is being forced to buy protection at any price, and forced buyers are price insensitive. Second, the market believes the shock is temporary. If traders thought this was the start of a multi-year bear market, the back of the curve would rise too. The fact that it doesn't tells you the crowd expects mean reversion. Third, and this is the contrarian part, extreme front-month fear has historically clustered near short-term bottoms, not the beginning of the pain. Let me put a number on the contrarian point. Historically, some of the strongest forward equity returns over the following 1 to 3 months have come after periods when the VIX curve went into steep backwardation. Not because backwardation is magic, but because it marks the moment maximum fear is already in the price. When everyone who wanted to sell has sold, and everyone who needed hedges has bought them, the marginal seller runs out. That's the fuel behind a snapback rally. But here is where discipline separates the survivors from the blow-ups. Backwardation tells you fear is elevated. It does not tell you the timing. In March 2020, the curve was inverted for weeks while the market kept falling. Catching a falling knife because the VIX curve looks extreme is a fast way to lose. The signal identifies a condition, not a date. Anyone who tells you the exact bottom is selling you certainty that doesn't exist. There's also a second-order lesson hiding in the curve for options traders. When the term structure is in backwardation, near-dated options are extremely expensive relative to longer-dated ones. That changes what strategies make sense. Selling that rich front-month premium can be attractive, but only if you respect the tail. Buying cheap long-dated volatility while the front is inflated is a very different bet than piling into short-dated lottery tickets after the move already happened. The shape of the curve should inform which trade structure you even consider. One more nuance most retail traders miss. The spot VIX and VIX futures are not the same thing, and you cannot buy the spot VIX. Every VIX-linked product you can actually trade rides the futures curve, which means in normal Contango those products bleed value every single day through roll decay. That decay is why long volatility ETNs are almost always long-term losers. Backwardation temporarily reverses that decay, but betting on it lasting is betting against the 80% base rate. So how do you actually use this as of today? Watch the ratio between the front month and the third month VIX futures. When that ratio pushes above 1, the curve is inverted and stress is real. Treat it as a checklist input, not a trigger. Combine it with breadth, with credit spreads, with what price is actually doing. A disciplined trader uses the curve to size down risk in the panic and to prepare a plan for when the front month starts to relax. Because the uninversion, the moment backwardation flips back to Contango, has often been a cleaner all clear than the spike itself. The takeaway is this: backwardation is not a crash forecast. It's the market telling you fear is loud, immediate, and probably temporary. It marks stress, it hints at mean reversion, and it warns you that the crowd has already positioned for the worst. Your job is not to be a hero at the exact low. Your job is to read the condition, manage your size, and act on your plan when the curve confirms rather than when your emotions do. If breakdowns like this help you think in mechanisms instead of headlines, subscribe. We publish calm, numerate analysis on volatility, options, and risk every week. Trade the process, not the panic.